sit on this, you're fine.
All right, I'll fill it.
Okay, good morning, everybody. Want to welcome everybody to today's event, Taxing the Gig Economy, sponsored by the Urban-Brookings Tax Policy Center. I'm Mark Mazur, the Robert C. Posen Director of the Tax Policy Center, and it's my pleasure to kick things off here today. We have two excellent sets of panelists today to discuss how tax policy should be modified to address changes in the workforce of today and tomorrow. And this is not a new issue. As Janet Novak, one of our moderators, pointed out, in the 1990s, BLS did a report on the contingent workforce. And so this is an issue that's been with us for decades, but one that's important to address for now and for the future. Our first panel is going to feature three different but complementary views on what is often referred to as the gig or platform economy. And our panelists will discuss the size of this economy, the scope, and how things may have changed over time, giving us a sense of the underlying trends with this section of the economy. And in our second panel, we'll focus more on the policy and administrative responses that are appropriate to deal with this changing business landscape. And we have four panelists who deal with the administrative and compliance side of the tax system from distinct perspectives, and they're going to share those perspectives with us on the second panel. I'm hoping for a spirited discussion of the alternatives of what can be pursued and what should be pursued. Let me take a moment to acknowledge our online audience today, people who are watching from afar. I would encourage all of you, both online and the people here in person, to share your thoughts and observations on social media using the hashtag #TaxingGig. And for online viewers, using this hashtag is a way to get your comments and questions into the discussion when we head to the Q&A portion of the program. For those of you here in the audience, when it's time for Q&A, I think we'll have a microphone to come around to get you to ask your questions. Please use the microphone. It makes it a whole lot easier for people in the online audience to hear what you're asking. Finally, let me offer a big thank you to the events team who organized today's discussion, Ann Clevin from Tax Policy Center, Anna Dawson, and the rest of the Brookings Institution staff who pulled all this together today for us. And now what I want to do is invite up the first panel to the stage. Our first panel will be moderated by Janet Novak, DC Bureau Chief for Forbes, and a long-term chronicler and observer of the tax policy. She'll kick off a substantive discussion with Mike Udell from District Economics, Adam Looney from Brookings, and Elaine Mogg from the Tax Policy Center.
Like that? Thank you. So we have a terrific panel today, and we're going to start with Mike Udell, who is the founder and managing member of the District Economics Group. And Mike started his career at the IRS studying the tax gap, the TCMP, and he spent many years on the Hill, the Joint Committee on Taxation. And I think what he's going to tell us about today is his analysis of the new Bureau of Labor Statistics report that came out in June, which suggested that we shouldn't all be here today because the gig economy is not really growing. Mike, you want to head?
Great. So this is connected, right? So I want to thank Brookings for asking me to come. First of all, we don't have a client in this space, so I don't have a dog in the hunt. I think that's a useful disclosure here. We really haven't studied the issue much. We come at it from two different directions. First, the SOI asked us to think a little bit about it, and we asked them to tabulate some information on it for us. And second, in a previous life, I was part of the team that wrote the statute, wrote 6050W, that has created probably the reason we're in the room today. So I have a little bit of just paternal linkage to the issues. So what the SOI asked us to do was first say, look, we have this new census report. It's trying to measure self-employment, and how can you square it with our numbers? So what we decided to do was take two perspectives. We first wanted to say, well, geez, does the census data align with anything in the tax data? And I think the first slide is going to say it probably does, but it doesn't capture a lot what's in the tax data. And the second thing, which we'll do in the next slides, is we're going to say, well, over the last 20 years, have things really changed in the self-employment space? So we decided to look at this problem with two different age groups. The youngsters, the people entering the labor force, we're going to look at them. And then I used to call them the older folks, but now I'm told that they're the more experienced people. So at this slide, the right-hand column is the recent data from the new BLS survey on contingent workers, and we compared it with the most recent SOI data, which is 2 years earlier. But these are two different surveys trying to measure the same thing, and what you can see in the two rightmost columns is that the BLS survey isn't really all that far off from what the SOI says. Are self-employed people whose predominant income is self-employment. The youngsters, BLS says 1.6 million, SOI says 1.7 million. That's pretty close. The more experienced folks, BLS says 2.4 million, and SOI says 2.3 million. That's pretty close too. The odd thing, though, is the first column, the one on the left, and that's the number of folks who report some self-employment income, but it's not the primary source. And this is what the BLS survey doesn't really pick up. So you can see these are big numbers. There's 4.2 million youngsters that aren't reporting as self-employed in the BLS data, but they show up on the SOI, and they only show up because they filed a Schedule C. So that's a problem, because I think one of the discussions today is going to be, well, geez, maybe a lot of the people aren't even filing a Schedule C who are self-employed. So this is just a quick snapshot to say, yeah, SOI and BLS are on the same page if you're looking at your primary source of income. Below this, there were a bunch of issues, and we won't talk about them because we're cut for time, but the bottom one, number 3, there are a number of tax code sections that are really relevant to created this, the reason we're having a conference. I hope the tax administration folks will talk about it. 6050WE is the information reporting provision. 6721 and 22 are tax penalties, and they turn out to have a really big impact on why companies are doing what they're doing in this space. We left off section 3406, which is backup withholding, and that's another serious problem for platform or gig economy companies. So hopefully those provisions will get shown up in the discussion. So which way? Forward? Right. So now we just wanted to say, geez, have things changed much over the last 20 years for youngsters and for people with more experience? And so this is just a frequency count of how many times a Schedule C shows up on a tax return. So in the leftmost column in 1995, the top gray bar says 2.9%. 2.9% of youngsters in 1995 had their income predominantly from self-employment. And you'll see that over the 20 years, that grew, all right? And that's actually the one thing that really is changing on this whole slide, is that the proportion of youngsters who are predominantly self-employed has grown quite a bit, 2.9% to 4.6% of returns filed by these people. That's pretty good growth. You'll see the maroon bars below it. Those are people who are showing self-employment income, but it's not their predominant self-employment income. And you see there's really not much growth there. For the experienced folks, the gray bar at the top from 1995 to 2015, there's really not much growth there. It's the same proportion of experienced folks who are filing, whether they were in 1995 when they were 56 to 65 or 2015 when they were 56 to 65. Same proportion filing predominantly Schedule C. So the takeaway from this slide is, yeah, there's growth of predominantly self-employed people amongst youngsters. And this is to 2015, which really predates the most important moment in the platform space, which happened in 2016. So this may become exacerbated in more recent tax return filings. So then we said, okay, how much has income changed for these folks? And one of the odd things is, if we look on the left side for the young kids, self-employment income as a share of their total income is flat. Even though there are more youngsters being predominantly self-employed as a share of total income of this cohort, all right, and there's obviously a lot of stuff going on here, but as a share of total income, it hasn't changed at all. And I think this sort of jived with one of the things that the Census Bureau was showing in their data, which was that the average earnings for self-employed people have actually been falling. And so this kind of bears that out, that as a share of income, it's not growing, but as a share of people with self-employment income, it's growing. So it has to be that the average is falling. For the more experienced folks, it grew. That's the best of what you can say, all right? And finally, we said, well, geez, has this changed on a per capita basis? Same snapshot. For youngsters in 1995, these are in real dollars, so we sort of scaled everything. They made $14,000 per return of self-employment income, and in 2015, $15,000. It's not really much of a growth over 20 years. For the experienced people, there was substantial growth, although it happened pretty much before the Great Recession. And that's, as Diane pointed out, I think in a blog post that she wrote for District Economics, this is just showing a kind of a life cycle effect, that experienced people are monetizing their experience and by becoming self-employed. So those were the key pictures that we wanted to show, which says, so far, at least through 2015, we don't see any earthquakes happening in the self-employment space on tax returns. We were then asked to quickly think about, well, are we really measuring this stuff? And our last comment, the comment that we left the SOI meeting with, was, this is probably the wrong place to look. If you want to figure out how big the gig economy is, it's probably the wrong place. You probably don't want to look at individual income tax returns. What we think you'd want to do is you want to look at the corporate tax returns. These platform companies are corporations. The expenditure for the sell side, which is the Uber driver or the eBay seller, that expense is probably one of their largest single expenditures. It's going to be on their corporate tax return. And it could be a miscellaneous deduction, but if it is, it's going to be itemized. So our suggestion was, if you really wanted to sort of gauge the size of this issue space, what you really want to do is take the 100 largest platform companies that are corporations, have the SOI do their editing, and then you want to compare that number, the deduction that Lyft took or Etsy took, the deduction that they took to pay their sellers. You want to go back and compare that to the information returns that they filed. So we know their information returns. They all have a corporate EIN. It's sitting on the 1099s. So if there's this big discrepancy between what we see on the 1099s and what the companies took as a deduction for payments, then that's a pretty strong indicator that the information reporting system is not tracking on the individual side this issue. And that's how we left it. We were raising our hand to tell the SOI we'd be glad to do that project with them. So far they've demurred. And that's just what I wanted to talk about.
Okay, our next speaker is Adam Looney, who's now back at Brookings as the director of the Center on Regulation and Markets. But for our purposes, what's crucial is that he was at Treasury as the Deputy Assistant Secretary for the Office of Tax Analysis. And even more relevant, in 2007, he produced a really in-depth look at the gig economy and what some of the regulatory and policy issues were, as well as how big is it really. So I think he'll talk to us about some of those findings.
Yes, well, thank you very much. Good to be here. I want to talk a bit about self-employment in general and then the gig economy in particular. I wanted to start with self-employment in part because I think a lot of the issues related to the gig economy are ultimately issues about self-employment. And a lot of the long-standing tax policy, labor regulation, compliance, benefit coverage issues that we'll talk about on the second panel are issues that are long-standing and have been issues that relate to self-employment for a long time. I also thought it might be useful to start off very briefly just to, in terms of my study, which was about tax returns and analysis of tax returns. Might be useful to have a brief primer on how gig economy workers and self-employed in general are supposed to file their returns. So to provide a little color on that, if, for instance, you work for a ride-sharing company like Uber or Lyft, they're supposed to issue you a 1099-K often for the payments for the services that you provide to your to your clients. In practice, the threshold for when those companies have to issue those forms is quite high. So it's 200 transactions or $20,000, the greater of those two. In practice, for many years, most companies had issued 1099-Ks to almost all or all of their ride-sharing partners. I know that not from looking at the tax data, but from reading like TurboTax's online forums and Reddit threads maintained by ride-sharing partners who clearly state that, like, I got this 1099-K, what do I do with it? Well, what you're supposed to do with it is you're supposed to take the information about how much you received in gross receipts from Uber. You're supposed to plug it into your Schedule C when you file your income tax return. On Schedule C, that reports your net income from your sole proprietorship. So you put on the receipts that you receive from them. You subtract any expenses, things like the cost to maintain your car or the standard mileage rate, any other costs associated with providing your service. Like if you offered water bottles to your clients, for instance, you would take a deduction for those. And then only if you earn $400 in net income from your Schedule C do you file Schedule SE, which is reporting self-employment income. And so that's a long-winded way to say that the translation from the number of people who drove a car or participated in the gig economy to those that file and report self-employment income might be a big gap between those two. And indeed, that'll be something that I think we come back to as well. So in our paper, we observed that in 2014, there were about 19 million people who had reported income from self-employment. That was up from about 15 million in the year 2000, so a 25% increase. A much larger share of people in 2014 had filed Schedule C. So about 25 million people had filed Schedule C, reporting some activity as a sole proprietorship. And so the gap between 25 million and the roughly 19 million who had income means that there were a lot of people who did not earn enough income to either earn a profit or to earn at least $400, and therefore did not file a Schedule SE, excuse me, and have income. And so that's a very big gap, and I think that we'll come back to that because it turns out that there's a lot of people who participate in the gig economy who don't earn quite that much money. And so a substantial amount of growth over time. I think as Mike's presentation suggested, a lot of that growth is not among people for whom self-employment activities is their primary activity. It was a secondary activity. And so it's relatively smaller and secondary to their primary job as a W-2 employee. Another thing to say is that our study only went through 2014. That's because the data that we had in hand at that time. Since that time, I think that there has been substantial growth beyond that, especially in the gig economy. And I guess I should pause for a second to say, in 2014, when we looked at self-employment, obviously the number of activities that people participate in is quite varied. So there are people who report self-employment earnings from being a partner in a big law firm to people who report self-employment income from being a babysitter or from mowing lawns in the neighborhood or to being a contractor. So there's a wide range of activities. Of that, the gig economy is a small share. So in 2014, when we looked, we saw that there were only about 100,000 people who had reported net income and filed Schedule SE reporting self-employment earnings from being a gig worker. So again, 100,000 people at that time is on the order of 0.1% of the US workforce. That was also a time when I think that if you looked at some ride-sharing companies' public statements, that they were saying that there were 600,000 people who were partners in their platform. So a very large difference between the number of people who are participating to some extent and the number of people who were then filing a return and reporting at least $400 of net income. Again, that was for 2014. I think since 2014, there's been very rapid growth. So I think that there are researchers at Harvard, Berkeley, University of Illinois, and the University of Chicago who are working on these issues. And I think that if you ask them, they would find that the number of gig workers who are reporting self-employment earnings has gone up to something like 600,000 people by 2016. So a very rapid growth. But again, probably growth that in secondary employment, not their primary employment. When we looked at the people who were participating, it was younger people. It was more likely to be men, less likely to be married. They had relatively low earnings. I don't think that that's attributable to the gig economy per se, but just from the fact that they were often using their gig economy work to supplement either having too few hours on their primary job or being between jobs, using it to consumption smooth, for instance, between activities. In terms of their net income, when we looked at how much in 2014 these workers were earning, we saw that they earned only about $6,000 from their activity, and that was contingent on having reported positive net income. So kind of relatively small amounts of money, even conditional on having earned any. And then I think if you looked at the number of people who engage in the activity, a very large share don't earn enough to be required to file. So something on the order of 40% of gig economy workers seem to have sufficient expenses or have such small levels of participation that they aren't required to file a return. In terms of other characteristics, they were otherwise quite similar to other self-employed workers. So for instance, they had relatively lower rates of coverage from health insurance, about the same rate, 75% coverage rate as workers who are self-employed versus a 90% health insurance coverage rate of primarily W-2 workers. Similarly, they were much less likely to contribute to a retirement account. So in the year that we studied, 2014, about 19% of gig economy workers had contributed to any retirement account versus about 45% of workers who had a formal W-2 job. And that's a little bit higher than other self-employed workers, but otherwise quite comparable. And so that's a quick overview of the population, and I look forward to our conversation. Thanks.
Next is Elaine Mag, and she is a senior research associate at Urban-Brookings Tax Policy Center. But what is relevant today is she has some new research she's just now crunching the numbers on, which is very intriguing because she's using the longitudinal study of youth. And Mike has just said that we have seen some increase in full-time self-employment among youth. So she's going to fill us in on, give us a preview of what her research is showing.
Thank you. This morning when I left my house, my very fashion-conscious 11-year-old daughter said, "Mom, you look exactly like a serious businesswoman." And I can see, except for the blue shirt, I have nailed it. So next time I'm going to be even closer. The work that I'm going to talk about I did with Liz Peters, Dan Berger, and Carrie Liu, who are all at the Urban Institute. And it's sort of been an ongoing project where we have looked at this in a couple of phases. So the gig economy gets a lot of attention, as we all know. And in some ways, it's really made self-employment more visible and more accessible. And that's why it becomes an issue for us. So we've always had people babysitting, paying others for rides, performing odd jobs, right? But utilizing platforms such as Lyft, Uber, TaskRabbit, and more have meant that people who would have made these connections in small communities, neighborhoods, churches, friend networks, can now make these arrangements more broadly, which with people potentially they have no connection to, and it's that interaction that I think defines the gig economy. And as it becomes more visible, it's natural to think it's a really important thing that's going on and something we should be thinking about. But yet, there's a data that's saying it's really not that, big yet, but maybe it's growing. But beyond potentially making the gig economy bigger, the platforms have also potentially driven activity that used to be sort of underground and informal into the above ground economy. So because I like to think about tax administration a little bit, that's probably good news for the IRS. At least someone has some data out there, and the question is, can they get it? So once the gig economy became more visible, it raised the issues that Adam and Mike have already talked about. And they have to do with, which laws does everyone have to follow? And the ones I'm most interested in are not the labor laws necessarily, but the tax side of it. So to sort of understand where the tax side is coming from, we want to understand if we've seen this big increase in the gig economy, or if it's becoming more prominent, do we think that's going to continue? Because if it's a temporary phenomenon, it's not a big issue for the IRS. They might have already passed it. But if we think it's going to continue, then it's something they should start to be really concerned about. And my argument would be that from earlier work, I think it's going to continue. And that's because of a phenomenon that a lot of people are talking about, which is income volatility. So there was some work done here at Brookings that shows that over time, incomes have become much more volatile year over year. And then work that I did with my colleagues at Urban show that even over the course of the year, incomes are very volatile. And of course, the gig economy provides an answer to that volatility. It's a very low entry way to do some income smoothing. So to just sort of scale the issue, there are half of all working age adults and almost 2/3 of all low-income working age adults have at least 1 month in the year when their income spikes or dips 25% above or below their average. So this is a big change that's happening. And nearly 40% of low-income workers have household income that's doing this spiking or dipping in 6 months of the year. So people are just experiencing a tremendous amount of volatility, and it's natural that they would look for ways to sort of smooth this. What we tried to tease out is self-employment smoothing that volatility, or is it the reason for that volatility? And we do find that people who rely on self-employment income have the most volatile incomes. They're the ones whose incomes are just bouncing around, sometimes every month. It's very difficult to predict what's happening. But in the case where people get about a quarter of their income from self-employment, the story's very different. Their incomes are still more volatile than your wage earner, someone who's relying exclusively on wages, but it's not that much of a difference. So in some ways, the gig economy is working as we expect it to. When you mix wages and self-employment, your income is smoother. So then what we wanted to look at in our current project is look at workers who were surveyed starting in 1979 compared to workers who are surveyed starting in 1997. And we break them up into two groups. We look at young workers, which kind of overlap Mike's definition, these 23 to 27-year-old types. But then we have mid-career workers also who are 30 to 34. We don't have older workers than that because our...
Experienced.
Well, I'm under 55, so I can still say older.
Experienced.
We don't have that piece of the pie because the folks who started getting interviewed in 1997 simply haven't reached that point in their career. So we find several things that I want to talk about. The first is that people who are self-employed in 1 year or receive some income from self-employment are extremely likely to receive self-employment income in another year. And that's important for tax administration because there's some sense of if the IRS can find you once and teach you how to fill out these forms, and you're likely to have that obligation year over year, then that's something the IRS can work with, and people can learn how to comply with the tax law. So that's probably good news. So it used to be in my older group, the ones that started being interviewed in 1979, about half of them would report self-employment year over year. And then as they age, those numbers increase. But by the time we're a little bit more current, so my 1997 cohort, again, about half of my young people report year-over-year self-employment, but almost 3/4 of this older group. So they're really settling into some sort of self-employment that's going to be coming into the household every year. Men are more likely to be self-employed. And if they're self-employed in 1 year, they're really likely to be self-employed in another year. And this, is important because of compliance. And then the final issue is that if you mix self-employment income, we also observe that if you're in this older group, you're really likely to be mixing it in a second year. So coupled with the fact that these platforms have some information and that people are experiencing these same sorts of income types year over year, I think that's potentially good news for the IRS. So the other thing we find is that there's a lot of differences in women and men who are self-employed. And one is that women who are self-employed tend to have children. They tend to be mid-career. And this looks a lot like other populations. And they tend to have quite low incomes. And this looks like other populations the IRS deals with. And those are folks claiming the Earned Income Tax Credit and child tax credits. And so here's an opportunity for the IRS to be thinking about a group that they're touching with one program, potentially touching from another angle. So I think that's also, some good news for the IRS. So overall, my sense is we're just really starting to get a handle on what's going on in this new gig economy. We're kind of having old issues come to the front. But I think that to the extent that these platforms are going to serve the function of being consolidators of people's labor, then it's probably something that hopefully the IRS can, find a way to work with them and figure out the compliance side.
Those are all very interesting presentations which tell us a lot and also how much we don't know. So after listening to the three of you and reading the work you've produced, there are three things that jump out at me. One is that the gig economy is larger than the BLS would tell us, but a lot smaller than the media hype from us and other people would suggest that it's growing and we push it. The second is that most of the policy concerns, health and retirement benefits and tax compliance, are not new. They've been around and they were studied back in the Clinton administration. And the third is that a lot of the platform work that we now call gig work is really producing, particularly on an after-expense basis, if you think of the Ubers of the world, very small amounts of income. So if I take those 1, 2, 3 points, then what the question I'm left with is, if much of the growth in self-employment is moonlighting, setting aside this younger cohort, that a greater percentage are now working as self-employed. Are there really any new issues we need to worry about? Or are they the same old issues of benefits coverage and misclassification of workers, which I believe, Adam, your paper said a lot of the growth you believe to be misclassification. But what new issues, or is it just the same issues with maybe a little bit of more hype and reason to pay attention because of the potential of the gig economy? And I wanted you all to address that.
You want me to jump in? Yeah. So I guess the first thing to say is the employer-employee relationship is very important for a wide variety of employer-provided benefits, for tax compliance, and for labor regulations. So the fact that your employer gives you a W-2 and withholds taxes makes you much more likely to file a return, makes you much more likely to be compliant with the tax system, and makes you much more likely to file the taxes you're due. Similarly, we provide a lot of employer benefits like health insurance coverage, 401k retirement coverage through the employer-employer relationship. And so that is a primary delivery mechanism for those benefits. And then finally, there are a whole number of ancillary other issues that we address through the employer-employer relationship. Those are things like the minimum wage, health and safety regulation, anti-discrimination rules. And so it is an important institution, and the long-standing policy battle has been about how to define that relationship and how to deal with cases where the employer-employee relationship is ambiguous or where employees want to divest themselves from that relationship. And so those are, in some ways, long-standing issues. I think that their importance has increased and grown and shrunk over time. It seems like a time today where the availability of online platforms has made it easier to kind of divest from the traditional relationship. It's an issue that I think that is important for federal policymakers, but it's also one that's being litigated in a wide variety of areas. So, internationally, I think the gig economy and certain cities have taken on this relationship and suggested that ride-sharing drivers, for instance, are employees. That's an issue that's been being litigated in cities and states across America as well to some degree. So I think it is an important issue. And it's very central to how we offer all these types of benefits and monitor compliance with the rules.
So your suggestion is that the platforms make it easier to divest the employee relationship, but Elaine is suggesting that the platforms may also make it easier for us to track who is doing this unsavory divestment and to perhaps require them to help us with tax compliance.
So let me chime in, because that's a yin and a yang, okay? And so the yin is, as Elaine says, look, the platforms have reduced transactions costs so that people can jump into economic activities with much, much less expensive. You can 1 minute be on a couch, and the next minute you can be in your car as a transportation driver, whether you're delivering for Amazon or you're driving for Uber or what. So the transactions costs that the platforms have created is just so low that people are now being pulled onto the platforms to do the job. That's the yin. I guess that's the good news. The yang is that the tax system has a flaw in it. I'm part of the flaw. And that is that conventionally these people everyone working on a platform would fall under a tax code provision that said if you're paid $600 or more in a year, whoever's paying you, in this case the platform, would write you a 1099. I write a 1099 to my landlord. I write a 1099 to my accountant. 6050W has this giant safe harbor sitting in there. It says, nah, it's $20,000 and 200 transactions. And so this $600 threshold and this $20,000 threshold are really the entire tension. And the platforms, everyone is driving into the $20,000 safe harbor because there's a letter ruling that came out in 2016 that said, yes, go ahead, If you're a platform business, the people you're paying, if they're not employees, they get this special $20,000 safe harbor. So what's happened, or we think it's happening, because we don't know quite yet, is that these people simply aren't getting any information that shows up at the IRS. They're getting information from the platform about what they did, and very detailed information, which is quite an opportunity for tax administration. But that information isn't necessarily getting to the Treasury because it's not hitting the $20,000 threshold. That's a serious compliance problem, not only for the income tax, but it's also really the payroll tax. It's really shortchanging the people who are providing labor on the platforms because they're not contributing to the payroll tax system, let alone unemployment, et cetera, the other traditional employer things that the costs the employers take. This payroll tax system is probably being really shortchanged here. It's just, that's an opinion. I don't know if it's a fact. So I think you have these two forces going on that are in tension, and the $20,000 threshold, the safe harbor, is really something that needs to be resolved. It can't sit on the tax code next to a $600 reporting threshold. There's an inconsistency there that needs to be addressed.
Right, but if you do take the opportunity to address it, right, the information's all there and available. It's not going to be more burdensome for any of these companies to produce the information. So it seems like we're at least a legislative stone's throw away from, fixing the issue instead of being completely in the dark like we used to be with self-employment.
No, that's right. I think the platforms, some of the breakthrough in the platforms is they've got all the content on all the information, so they've reduced. Not only have they reduced the transactions costs for people to provide labor into the economy, which is a huge plus, but they've also reduced the transactions cost of what used to be traditional HR functions. It's all in the back room. If I'm going to drive on Uber, I don't go anywhere. I do it all on the platform. The entire HR function is on the platform. If the platforms are evolving that way, and for example, Handy does a lot of background checks on their platform, the platforms are actually capable of providing a tremendous tax administration. I would call it an agency relationship. They have the information. It's electronic.
But they don't have the information about your expenses if you're an Uber driver, which is part of the problem.
It's a stone's throw for the transportation companies to actually populate a Schedule C. It's just a stone's throw because the service has a mileage charge. The platforms know exactly how much miles you drove. It may not be net income at the end of the day because of other expenses that they can't see through, but this is so much closer to net income than gross proceeds reporting. And that has been the big evolution in tax information reporting, is going from gross proceeds down to net income. So, when we did 6050W, it's a gross proceeds reporting mechanism, but the platforms have a lot of information, not all of them, about the deductions that ought to flow.
So what we would need, information reporting generally only gets passed within the context of a deficit reduction package, right? Because it's not popular. So we would need some kind of a package where it gets slipped in.
That's right. They need the revenue. That's right. So just...
And since we have big deficits, that's positive, right?
I don't know if this is going to solve that problem.
Let me ask you something that is going to sort of be contrarian. We traditionally have looked at self-employment and we said, well, some people want to do it, but other people are pushed into it. I'm wondering whether the percentage of people who want to do it may be rising for a couple of reasons. One is that with the demise of defined benefit pensions, well, all you get anyway is a 401k, and you can save for yourself with a 401k. The second is if the Affordable Care Act survives, there's a way to get health insurance. And the third, of course, is with the new tax law, Section 199A, there is a real tax advantage to being self-employed. Plus, there's a different, I think, I have all these millennial writers who work for me, a different attitude towards employers versus self-employment. So do you see any evidence or do you have any thoughts on whether the desirability of self-employment may be rising, and that could, in fact, mean we'll have more of it.
I mean, so I agree with everything you said, and I do think it becomes more attractive over time. So the Affordable Care Act in particular, by decoupling health insurance benefits to some degree, to a large degree, from the employer relationship was very important. And so in the work that I quoted from earlier, it looked like 11% of gig workers in 2014, the first year of the ACA, were being covered by marketplace coverage. I think that number has probably doubled, just because overall marketplace coverage more than doubled in the subsequent year. So I think a very large share of gig economy workers are using the marketplace and benefiting from that. I think that is an important way of providing coverage to that group. I think it makes it more attractive to engage in a non-traditional employment activity like self-employment. We've kind of already done a lot of that for retirement coverage, where people can, if they want to, go out and sign up with Fidelity or some brokerage to have an IRA or something like that. And then I think certainly 199A makes it more attractive to be self-employed rather than being an employee, just because you get a very large exclusion from your income for that. And then, I wish I could speak to the attitudes and impressions of the millennials. I don't know that I'm well positioned to do that. But I do think that there is some flexibility offered by this, and people enjoy that. So and then I guess the other thing to say is that it certainly is growing quickly. And so there are a lot more people who participate in these platforms and who use them to supplement their other income. So it is clearly a very active area and growing quickly.
Although, as we've been saying, the platforms may be consolidating the kind of informal work people were doing before, right?
Yeah, and I think also expanding there.
Yeah, definitely.
If it used to be your kind of local groups and your the network that you could drive yourself, suddenly there's a whole city or a local area that's available to you to market to, in effect.
Mm-hmm. When I apologize, I'm a news person. This is an on-the-news question. When we talk about the policy failings, Adam, we talk a lot about retirement. And yesterday, the Department of Labor came out with a suggestion that they would let independent contractors join these multi-employer organizations for the purposes of 401ks. And I was left with the question of why we have IRAs, we have SEPs, we have solo 401ks. What we don't have is automatic enrollment or maybe the spare cash to contribute. Do you think that this makes any difference? Is this a policy solution, or is it just window dressing?
I mean, so my impression is that a lot of the challenge that people have saving for retirement is having the cash to save, and a nudge perhaps from their employer to encourage it. So I think that there is something to having an employer that automatically enrolls you or that provides you a nudge to enroll, and you don't necessarily get that from being self-employed, and beyond a nudge, you have to kind of very actively seek out a provider. So I can see that being a barrier. But at the end of the day, I think a lot of the problems we have with retirement coverage are not about people. I think they're about people not having the income to save and the pocket money. So in some ways, I think that those types of efforts to make them more available or to nudge people are intrinsically limited.
Elaine and Mike, both of your research seems to suggest that more of the younger cohort are persisting in self-employment. So the question is, could that be an artifact of the Great Recession? Or are your numbers from such years that it is not that?
So the years that we're looking at right now, we specifically avoided the recession years because we were concerned that we'd get an artificially high number. I think that absolutely, it had to have happened, right? When the regular jobs go away, you still need income, you still have expenses. I think it's natural you would look to places to plug those holes.
Yeah. No, I would agree. So I mean, we just got very lucky in our data. 1995, 2005, and 2015, if you think about where they are in the business cycle, all 3 of those years are in the upswing part of the business cycle. So we were just lucky that we were able to use those kind of years. So I don't think we had the Great Recession effect, although there is a Great Recession effect in terms of income of the experienced people. It's simply flatlined between 2005 and 2015 from self-employment activity. So, the Great Recession clearly has changed earnings quite a bit, but at least in our data, we got good data points because they're in a similar part of the business cycle. But I do want to go back to the individual and the 401k or the SEP IRA problem. One of the things that's happened in the tax code is originally for self-employed persons, we would pay and I'm self-employed, we would pay our estimated taxes quarterly. Our employees, they get their estimated taxes paid with every paycheck. And originally that structure was set up because it's burdensome for the self-employed person. Well, we know from tax compliance that self-employed people have pretty poor tax compliance. It shouldn't be lost on people that with the platforms, we could actually flip a lot of this problem on its head and solve it. It is administratively burdensome for the self-employed to do these activities because they have to do them themselves. We have to pay our estimated taxes, we have to put away money, and we have to do it in a lumpy way. To the extent that self-employed people are now earning their labor income on platforms, there's no reason that a platform could not do all those activities. They have all the information, and so from a tax compliance burden perspective, the platforms actually offer a tremendous opportunity to address some of the non-compliance problems of the self-employed. The platforms can withhold. They've got the money, they've got the data. The platforms could contribute to some kind of a savings plan. They have all the money. We don't have a client in the space. I'm just saying that in the older days, all that burden sat on the sole proprietor. I had to do it. All right? And I'm terrible at filling out a quarterly estimated tax payment because it's scary, because it gets so large. But for my employees, they don't even notice it because it comes out like every paycheck. Maybe they do notice it, but it comes out every paycheck. And so I'm doing their compliance burden. So in a sense, we've got the tax administration system sort of upside down with respect to self-employed. They are the burdened group right now.
I think we should be going to the audience for questions.
Sorry.
Does anybody? Yeah. Yes. Go ahead.
Hi, my name is Christina Fitzpatrick from AARP. And I have a question about data. We are trying to get a grasp on what we are talking about here, about the gig economy, how big it is, how much it's growing. We have IRS data. We have current population survey data. And I'm wondering what we know on the individual survey side about how people who are self-employed, who are doing this gig work, how they identify. So when you ask them, are you self-employed, what do they say? And for all these other questions, as researchers, we have to interpret what they're saying, and we don't know, I don't know, what they're thinking about and how they respond to these questions. So is somebody looking at that, and what do you know about it?
So I think there was a paper that came out pretty recently that says people aren't really good at reporting their self-employment on these surveys. So, it seems like we're most certainly undercounting.
Yeah, I mean, I agree. So I think that there are different kinds of errors that people make. So I think there are some people who interpret their relationship as an employer-employee relationship, and so they even if a ride-sharing company suggests that they're self-employed, they might still put down their income as wages or report that they are an employee, and so that certainly happens. And I think there's also people who make the mistake the other way. So, but although I think the primary way is to think that you're an employee, even if you're filing as self-employed. And so that's part of the divergence. So you see a divergence between the tax records and the CPS in terms of the number of people who report being self-employed. There's more self-employed tax filers than there are respondents who say that they are self-employed.
Didn't Catherine Abraham's paper kind of look at this and find that some of the people who tell the surveyors that they're employees really probably are but their employers don't treat them as such. Therefore, they have one source of income on that Schedule C, and they don't necessarily have a lot of employee expenses. So, you know, they're going to work and they're told what to do. So they don't consider themselves self-employed, but for tax purposes, they're treated as self-employed.
Yes, that's right.
Yeah. So that would be.
And again, it's a complicated, I don't remember how many questions are in the test of whether you're an employee or a contractor, but it is a very long facts and circumstance test. And the IRS has not been able to issue guidance since the 70s.
78, yes.
Yeah, 78.
They were told, don't do anything new on this.
Yep.
Yep. Yeah.
Ken Simonson with Associated General Contractors. Very interesting data and analysis of it. I'd like to see this 3 years from now, because I'm wondering, is this a phenomenon of the business cycle and specifically the level of employment, or of age groups? So are these 25 to 35-year-olds likely to transition out of doing gig work? Are the people in the 55 to 65 age class, as they leave paid employment, are they likely to do more gig work themselves? And also, as wages or compensation start to accelerate, as we seem to be seeing in the last few months, will that draw more people away from doing gig work and into wage-paid work? And so I wonder if any of you want to speculate on those things.
So I think those are really interesting questions, and that's one of the reasons we're using the National Longitudinal Survey, because we can, you know, look over someone's, you know, entire career, and we have a pretty long horizon. We're not going to be able to answer for 2018 because we don't have those data, but that's the next step in the research. So we've sort of got the data so we can look year over year, and now we're going to daisy chain it all together so we can look over someone's entire career. So that's a great suggestion, and, you know, it'll be in the paper.
Anyone else have it? Yeah.
Kim Rubin, Tax Policy Center. And this might be a question that is better served in the next panel, but I at least want to push you guys a little bit on it. So I believe all your conversations about why it is easy for platforms to collect this information and give it to the IRS. But I am also guessing that the platforms really don't want to do it. Like, there is a reason that they like having a $20,000 limit and the safe harbor views. Can you give your perspectives on both why you think that this is something that is not onerous on them, and also what reasons you think they would give for why they shouldn't have this responsibility? And then we'll ask it again in the next panel.
Can I? So let's give a little background here. So the statute was written in 2007, right when the iPhone came out, but before the App Store came out. So we didn't have platforms. Well, we had eBay, okay? And so the entire reason that the $20,000 safe harbor is in there is the following. If you go to a flea market, if you were the IRS and you started walking around a flea market and said, I want to see that income reported on your tax return, all right? The IRS doesn't do that, all right? But if you actually said, I want to see that income, and the person sat down and calculated what they earned in the flea market, and then they subtracted cost of goods sold, in most cases, the net income would be zero, all right? So when people are emptying out their attic and they're selling it in the flea market, there's no income there for the tax system. So along comes eBay, and eBay was a nationwide flea market. I mean, that's the way to think about it, all right? Yes, there were a whole bunch of big overstock sellers selling their computers, but at the lower tail end, where the bulk of the participants were, it was a nationwide flea market. And so we realized very quickly that if we required 6041 Cap A reporting, $600 of gross proceeds for people who were selling stuff on eBay, and if we flooded the system with those 1099 documents, and the IRS put that into a document matching program, which is the entire reason to have an information return, they would be overwhelmed with what we would call false positives. They would see a gross proceeds on a 1099, they would shoot out a nastygram, some CP notice that says you owe us $1,000 times your tax rate, pay up. And in fact, there was no income at all. So we realized that if that were to happen, what the IRS would do is they would pull the plug on that Form 1099. They would not set that system up. The 1099s would end up on a transcript, and if you were audited, it would show up there, but it would be useless to the system. So the $20,000 safe harbor came in because, as a rough justice, to figure out how to prevent the tax administrator from being overwhelmed with really bad information. And so $20,000 was sort of the threshold where we thought, yeah, you're in a trade or business above that, and you're emptying out your attic below that. That's how the safe harbor came about. So it was for the sale of goods. When we wrote the statute, the word "and services" showed up because goods and services never are separated. They're like twins in the tax code. So you don't have a statute that says just goods. So in drafting, it was goods and services. This is before the App Store showed up. Now all the services came on the platform, and they said, well, we fit that. And there's now a letter ruling out there that says, yeah, you do. And so everyone's driving through that $20,000 safe harbor. But for labor services, there's income. It may not be very big, but there's income. And so this is the problem that got created.
Yeah, I mean, can I say one other thing? So, I mean, I think that the ultimate challenge in tax compliance is that you're spending real resources to effect a transfer from the taxpayer to the government. And the question is how much of the pie are you burning by trying to promote compliance? And so in this case, it seems like unlike other cases of general contractors, for instance, where it might be very costly to require reporting of how much you paid somebody. Here it seems like it's maintained in the database. It's fairly accessible. It's inexpensive to provide this information. The companies have for many years already provided it for every person on their platform down to like small dollar amounts. And they also provide it to their employees in the reporting. So a lot of that information is already available. I think on the other side of it, though, that the IRS, I think, hasn't got a good sense of how they can use the information. I think there are some people who do get the CP notices saying, like, I see that you have $8,000 of gross receipts. You owe me $5,000 or something with penalties. I think that's a surprise to the clients of these companies. I think it's a waste of time when ultimately they do file a return saying, well, you know, actually, I was a driver and I didn't have that much income. So I think there's some sorting out. I don't know that the optimal level of reporting is $0 or necessarily even $600, but I imagine that they can probably do a better job of providing information.
And then the platforms are resistant to doing this because they don't want to be considered employers, because they don't want to pay the employer taxes and, you know, that side.
And maybe because they can get away with paying people less net if those people aren't reporting and don't have tax obligations, you know. That's a factor. I think we have a really interesting question that came in online about the bifurcation of the self-employment market. Because, Mike, your numbers show that among the 55 to 65-year-olds, the older people with their human capital, their earnings per self-employed person are actually going up. Whereas we see in the younger self-employed group, who may be doing some of the TaskRabbit or pickup work, that their average earnings seem to be going down. So are we seeing a bifurcation in this self-employment market between high-skilled knowledge workers and people who are just responding to what the platform asks of them for that hour? And do we need to have different policy or tax approaches based on that?
I think that these are the tale of two cities. For the experienced folks, I don't think they're really that much on the platforms. I could be wrong, but when you're earning average $39,000 self-employment income, that's not typical platform kind of net income. The experienced folks are monetizing their life cycle effects. They're monetizing their professional experience. The younger folks, this is actually the census. Catherine Abraham's paper is really good at this. What we think is happening is that there's just an increasing number of young people moving onto the platforms, and what's happening is that they're sort of moving down the supply curve and they're earning less and less and less, and so average earnings are falling just because they're adding more and more people who are only working 10 hours a month, all right? And that's because the beauty of the platforms is the transactions costs are so low, so it's easy to hop in. And I think that the average earnings number can be a bit of a misnomer because it's belying the distributional change that's going on. It's not that all of a sudden people are earning less. It could be that the hard, if there's such a word as a hardcore Uber or Lyft driver, someone who's really working at it, their earnings may even be going up. It's just that because transactions costs have reduced, access to the platforms is encouraging people to join. And we're getting a big tail of people working a little bit.
And we see in the NLSY our older group of workers in the more recent data. Men seem to be earning more. Women seem to be, that 25th percentile tail is getting smaller and smaller. So low earners are earning even less if you're a woman.
Did you have something you wanted to add?
No, I think they covered it.
Well, we're almost out of time, so I'm going to ask if any of you had something you wanted to add that I kind of glossed over or that has come up in our discussion.
I'm good.
Is there anyone with a burning question? Okay, we have time for one burning question.
Excuse me, Gerald Chandler. I'm not sure it's burning, but I'm sure of your definitions. Gig economy and platform economy are not exactly the same. And if we look at the traditional gig people, which are doctors and lawyers, are you including them?
I mean, so I'm thinking primarily of those who are on the online platforms. And I mean, I feel like they're, and even more than that, I'm usually thinking of people who are providing services through the platform. So like drivers and workers, not necessarily even like the Airbnb or VRBO types. And then the original, that term has been expropriated from, I think, the gig economy of before, where it was kind of, a much broader class of workers.
Yeah. I think Catherine Abraham actually had a really nice little comment in one of her papers that she thinks, and I'm going to trust her, that gig came from a session musician showing up, and a gig was a one-off, a one piece. All right, you did one job, you did one product, and you handed it, and that was done. You were done with that relationship. I really think gig is a misnomer here. The whole discussion is about platforms. Everything is really about platforms.
In your initial data of self-income, does it include doctors and lawyers?
Yeah.
So ours does in the NLSY. We're looking, we have some very wealthy people, and we have thought about should we be treating them differently in the analysis. Right now, we sort of look at people at different points in the income distribution because we think the issues are probably a little bit different for someone making $4,000 a year versus $90,000 a year.
Yeah. Well, thank you very much. That was very
Great.
interesting. Thank you.
I unplugged you. I'm sorry. I totally forgot about it.
Thank you.
Just got it now. Okay, great. Sorry about that.
That's okay, thanks.
You go tell Diane to start writing.
Yes, I will. I'll text her right now because I think she's listening.
Okay, we're going to have a quick little changeover here to our second panel and get them mic'd up. I just want to remind people who are watching online to use the hashtag #TaxingGig to get your questions and comments in, and also to participate in the ongoing discussion. We had a couple of good questions from the online audience in the last session. I'd like to see that going ahead on this session too. It's okay. It's okay.
Steve King gave me a very interesting call the other day. And I was like, I need to talk to David Williams about that. Oh, yes. Thanks.
Okay, everybody, we're all set. Welcome to the second panel where we're going to discuss tax administration specifically as it relates to the gig economy. I'm Howard Gleckman. I'm a senior fellow at the Tax Policy Center and the editor of our blog TaxBox. I'll briefly introduce everyone else. David Williams, to my left, is Chief Tax Officer, Executive Director of Intuit. Next to him is Carolyn Bruckner, who's the Managing Director of the Kogod Tax Policy Center at American University. Next to her is Pooja Kandabolo, who's the Senior Tax Policy Manager at Airbnb. And finally, Nina Olson, who I guess everyone knows, who's the National Taxpayer Advocate at the IRS. So we have a range of perspectives here from the private market. Pooja, I know we're going to put her on the spot because at the first panel, everybody was asking, why don't the platforms do this? Why don't they do that? So we'll find out what the platforms really do. But I'd like to start actually with David because Intuit has actually done some surveys and he can do some level setting and give us a sense of what they found in terms of gig taxpayers. David, go ahead.
Thanks, Howard. It's a pleasure to be here. The views I'm expressing are mostly my own. Occasionally I'll represent something, but the key that I wanted to bring to this is that we engage with taxpayers and business people, self-employed or otherwise, in a variety of ways. Two major ones, our two lines of business, are tax preparation, obviously, and then online accounting. And that will become important, I think, later as we talk about how one actually invests gig economy or self-employed workers with the knowledge to actually comply with their taxes. We heard earlier in the panel discussions about how the platforms could do this, but we also heard Adam describe the process for tax compliance for self-employed workers. And I noted a number of the experts in the audience scribbling notes. And if you think about that, think about the average worker trying to understand what those compliance challenges are. What you'll see is what's reflected in our data, and one of the key points and takeaways, which is that most people do not even know what they don't know. And I'll give you just a bit of an example of that because I think that's relevant here and more broadly with regard to whether people understand the consequences or changes that the recent tax law will have on them. We do have a number of surveys, but one that I think somewhat interesting with regard to tax reform and tax cuts specifically. Only a third of the self-employed people we surveyed through our platforms had any sense of whether they benefited financially or not. Most of them decided that if they did, they would put some in savings, some in health insurance, and some in retirement, but they weren't quite sure what. But that was only a third. The other 2/3 hadn't seen any impact at all, and they're sure something's going to happen, but they're not sure what it's going to be. Now, these are folks, by the way, many of whom may or may not also have a W-2 source of income, but they're completely in the dark, essentially, about the impact of tax reform. More to the point, they are confused about how to comply, and that brings me to the second point. We heard a lot about the potential of the platforms to describe or disclose information about income, because, as Mike said, they have most of it. It's only a stone's throw. I think that was Elaine's comment that Mike appropriated, but that they may be able to touch that side. I think the reality is, and what we see with our customers, is that they leave money on the table. In other words, they don't actually understand what is deductible, how to think about that in the context of themselves as a business. Many of them are used to W-2 income, and when they step into the gig economy, or frankly, self-employment in general, concepts like saving money to cover their own tax obligations as self-employers don't exist. Withholding doesn't exist. And if any of you have done a statistically valid survey of Uber drivers that you've been with, you'll know what I mean, because many of them will say things like, yeah, I know something about that, but we're not sure what. We are also noting that there is no consensus about what this looks like, and you can hear that on the panel. I think the whole point of the first panel was a discussion about different perspectives on what's happening. We have ours in which we're seeing growth. Interestingly enough, if you think about it as a barbell, folks over 100,000 who are gig economy or self-employed seem to be increasing. Folks who are making a fairly small amount of money At the lower end, those side giggers seem to be increasing, and those in the middle, at least initially, do not seem to be growing as a class of folks. We'll see whether that holds true over time, but I think the notion of higher skilled workers who are making over 100,000, and I think Mike referred to them as monetizing or what they've built in terms of human capital, is something that we've actually seen in some of our data. We also, and I think I'll close with this point, coming back to this notion of not knowing what you don't know, we did do a survey of self-employed workers and found about 36% of them report not paying taxes. And 46%, and this is the stat I'll close with, 46% of our respondents who are that younger cohort, or whatever word we want to use for it, say they've been audited, which we thought was quite interesting. Now, as you can imagine, for us as a company that's trying to serve and enable people to comply with their financial obligations, including their taxes, that's a subject of concern. And so I think the last point I'll close with is, I think it's worth a discussion once we've figured out what the tax administration consequences are, which I think we'll hear about from the panel. It's really worth thinking about how does one enable a self-employed worker or a gig economy worker in general to understand and therefore be able to comply with her or his tax obligations. And I would submit to you having two lines of business, one of which is episodic, which is the moment in time in which one prepares one's taxes, or ongoing, which would be the accounting engagement that we try to build and the ongoing engagement with our customers, that it is probably not the episodic moment that is probably best for educating and enabling people to comply with their tax obligations. And for those of you who are currently employed with a W-2 or remember it, I'd ask you to think back to that moment when you signed up, started your job, and maybe were handed a piece of paper that told you what to do with your taxes, filled out your W-4, if you could understand that, and then I'd ask how long you remembered that. How long does that stay in your mind? And how long, and did you remember that when you were thinking about your tax obligations and compliance? I'd submit to you, and our data suggests, that most folks do not have that top of mind in their day-to-day lives, and therefore are probably not as prepared as they might be to comply with obligations when they're self-employed. Let me stop there.
So Dave, before we move on, I have to ask you, of that nearly half of people who thought they had been audited, were you able to explore a little bit and find out what their interaction actually was with the IRS?
So it's interesting. I got that stat over the weekend, and it sent my eyebrows up, so I've asked. I want more data about it. I don't have it right now. But the bottom line is they think they've been audited, which means they've gotten a contact with the IRS asking them to validate something on their return, period.
Interesting. In the first panel, there was a brief mention, I think, from Mike about self-employment taxes and asking about what was going on there. And as it turns out, we have somebody on the panel who can answer the question. Carolyn has actually done a paper looking at the effects of self-employment taxes in the gig economy. So tell us a little bit about what you found.
Absolutely. Thanks, Howard, so much for having me. My name is Caroline Bruckner. I'm a tax professor on the faculty at American University's Kogod School of Business. I took over for Dave Cowder as managing director of the Kogod Tax Policy Center. And just this month, we released a paper entitled Failure to Contribute, which is an estimate of the consequences of the non- and underpayment of self-employment tax by a population of independent contractors and on-demand workers. This follows our 2016 research, which we produced in a report titled Shortchanged, which was essentially a survey of experienced self-employed workers that were doing work in the on-demand platform economy and how they interacted with their tax compliance obligations. And our latest research builds on our prior research and has three primary takeaways that you should consider when it comes to understanding tax compliance and on-demand workers. First and foremost, the numbers. We identified a population of independent contractors and on-demand workers, not just platform workers, but people working both on and off platform. And we estimated that there was about $7.3 billion of self-employment tax that didn't get paid for 2014. And that translates to about $6 billion of Social Security contributions that weren't made by these workers. And that matters. This is just 1 year, and this is a population that when you look closer at the demographics and you look at the nature of who's actually doing on-demand work generally and specifically platform work, these are people that tend to have a greater reliance on Social Security as their primary retirement vehicle. And so we looked a little bit deeper into the demographics of the specific census data that we looked at. We were lucky enough to get to work with some great experts from Census who are here today. Super excited to see you. Thanks so much for coming on our census data. And our data is a little bit different from other work that's been out there because we found that there were actually a few more women that were doing this work, but we also looked more broadly at on-demand work than just platform work. But the second takeaway from our paper is that the reason that most of these people, a major factor that most of these people aren't paying their self-employment taxes is because they're not getting a 1099 from the platforms that they work with. And it's because the thresholds for furnishing a 1099 are just simply too high. And as the first panel indicated, those rules were never contemplated to encompass the on-demand platform that we see today. And they're inadequate, frankly, for these populations of people that are identifying customers and providing services and goods through platforms that are processing payment. There are millions of these workers out there, and very few of them are hitting that $20,000 threshold. They tend to cycle in and out of the on-demand platform work, and they do it as a supplemental secondary source of income, not their primary source of income, and rarely do they exceed $20,000 in their annual earnings. And for those that do, those on Airbnb, for example, tend to make more money, but it's not often that they exceed more than 200 transactions doing Airbnb. So a lot of these people aren't getting any 1099. And the IRS has, established tax gap data that shows you that when there's no employer withholding or information reporting in place, you have a 63% chance of misreporting your income. That's going on, and we looked at it specifically with respect to self-employment income. The third takeaway that we found from this work is that what the gig economy looks like today is not going to be what the gig economy looks like in 5 years. Yesterday, the Post reported that Ford is test driving autonomous vehicles on the streets of DC. They plan to be commercially viable by 2021. If you look at the data on the on-demand economy, it is, in fact, the transportation sector, and this is the JP Morgan Chase Institute data, that's driving the bulk of the work and earnings that's going on with on-demand platform work today. Driverless cars is going to change the nature of that 5 years from now. And but when you look a little bit deeper into the data and you talk to the folks at JP Morgan Chase and you say, well, what are the other areas of growth that you see with the on-demand economy? They say that it's other services, and in particular, care work. And when you think about our aging demographics and you think about the reality that 10,000 baby boomers retire every day and will continue to do so between now and 2030, there's going to be a greater demand for care work. And it's not necessarily, at least obvious to me, that you're going to be able to have automation replace that kind of work. But what you will see is that kind of work migrating onto platform work. It might have been typical cash economy work in prior decades, but now platforms are starting to experiment with that and other types of temporary staffing work. Uber just announced Uber Works. It's fielding tests on a new platform service in Chicago right now on temporary staffing services. And care work's going to become a bigger part of the on-demand platform work that we see. And the last thing that we really learned about through doing this research is that when you look at on-demand work generally, not just platform work, the major trend that we see that really shows the inadequacy of our current information reporting rules is that you're seeing a digitizing of the cash economy. And let me give you a really good example. Last week, I was approached by a freshman on campus who came to me and said, I've got this business I'm running out of my dorm room. She's become so successful. She's 18 years old, has been on campus for 2 months, has been so successful, she has an online booking service. And she said, I need help. You're a tax professor. I need help, trying to figure out my tax obligations. And I said, okay, well, how are you getting paid? Oh, it's all cash. And I said, oh, really? And she said, yes, it's all cash. How are you getting paid? Venmo. All of her friends are paying her via Venmo. And when you talk to people and you talk to students and you ask, how do you pay for goods and services? I just did a random survey last night of at my class. All of them raised their hands when I said, do you use PayPal or Venmo? And have you ever used that to pay for goods and services online? every single one of them raised their hands. So these are the trends that we have to keep in mind when we're talking about the tax compliance challenges of these populations, not just where we are in this moment, but where we're going.
So Carol, let me just ask you to close the circle on the payroll tax issue. So they're not paying the payroll tax. So who's hurt by the fact that they're not paying the payroll tax?
So when you look at the demographics of these populations, my data is a little bit different than what other people have looked at because we looked at a very specific census data, the SIP survey, and we found that the majority of people that were doing independent contract work or on-demand work were either Generation X or baby boomers, and they were older. And we also had a slight difference in that we had more women versus men doing it. And that's hugely problematic because women over their lifetimes have a greater dependency on Social Security because they live longer and they have higher healthcare costs than men do. But over the course of their lives, because they tend to take time in and out of the workforce, their Social Security earnings are generally lower. So when they're not paying in, even on this kind of work that they're doing, which is supplemental work, they're disadvantaging themselves because over the long scheme of things, they're not including those types of earnings for their calculation on their ultimate Social Security benefits. Now, it's really hard to extrapolate out how a gig economy earnings for 1 year would affect a lifetime of earnings. And that would be disingenuous to say that, we could do that kind of calculation. But what we can do is, point out the obvious. These people are not paying self-employment tax, and on the front end and on the back end, these people are more likely to be lower income and that they're going to have less Social Security benefits as a result of it because they're not crediting their accounts.
Good, thanks. Pooja, before we ask a little more about what the platforms could do, talk to us a little bit about what they do. We've heard about the $600 threshold. We've heard about the 20,200 transaction threshold. But tell us, first of all, what Airbnb does, but also give us a sense of what you hear in the industry about sort of how this really works, how this works in the real world.
Sure. And for those of you who aren't familiar with Airbnb, we'll quickly walk you through our business model. So basically, we're a marketplace, a facilitator. On the home side, we allow hosts to set up their own profile, take pictures of their listings, and upload that onto our platform. We don't ask them a lot of questions. Basically, name, basic information, and their, of course, payment details. On the guest side, similarly, just basic profile. We do verify their identity, and we ask basic questions for background checking purposes. And that's about it. We recently launched another tier of our business called Experiences, where we allow hosts to basically list their hosting experience that they're a professional or a subject matter expert at. So think if you're going to Peru, someone who knows the ins and outs of Machu Picchu can take you on their own self-guided tour. And the reality of the situation, this came up in the previous panel, I'll just speak based on my experience working at Airbnb over the last 2+ years. We don't collect a lot of information. We're a technology company first, right? So we collect the basic information that we need for payment processing. We don't know information such as what percentage of our hosts are posting or listing on different platforms, what percentage of our hosts use the income that is earned on their platform as their primary source of income. We're also a global company. We pretty much operate in every country that has internet access and has a stable government. And as you can imagine, a lot of what my day-to-day includes is speaking to different governments about what we do and what we can, help in terms of increasing our hosts' tax compliance. That conversation is very different in Russia than it is in Estonia or Denmark. And currently, on the host income tax side, this was previously discussed, so we report in the US based on the current threshold of 200 transactions and $20,000 of income earned on the platform. And as you can imagine, that's not a large percentage of our hosts. We have publicly supported last year, Senator Thune came out with a Gig Economy Act bill that would lower that threshold, and we're in support of it. We understand that the bill was contemplated at a different time when the gig economy wasn't nearly as big as it is today. And so also in the US, that's the only country in the world where we're currently withholding. And actually from an operational and product perspective, it's very difficult to withhold. Also as a payment processor and kind of, you know, the holder of money for a period of time, there's just a lot of legal liability and consumer protection issues that we're cognizant of. We also report in Ireland based on our entity there. But as you can imagine, more and more countries across the world, especially in Europe, are really interested in this discussion. And what I tell them is we want to make make this easier for them, and we want our hosts to be compliant. But given the fact that we are a global company, we need simplicity. We need reasonable rules that capture the entire industry. As you can imagine, Airbnb is the face of home sharing, but we're not the only home sharing company. And we sometimes, find that, rules are just kind of capture our business models and not our competitors. We also, given that we, how do I put this delicately? Being in a disruptive technology company, right? Regulations, the regulatory issues are huge. And data is the name of the game, and we understand that, but we also don't necessarily want to be an enforcement vehicle against our hosts on the regulatory side. So on the tax compliance side, we completely understand that this is a must, but if that information is used to to understand what our hosts are doing on the regulatory side, whether they have a business license, whether or not they're zoned properly, that's something we take into consideration. And a lot of what I spend my time on is actually not on the income side, it's on the indirect side. Airbnb, our business model, I guess, is similar to that of hotels, and many of our hosts have the obligations of remitting hotel occupancy taxes or similar type taxes, and many times they don't necessarily understand or have the bandwidth to comply with these complicated laws. So we think we're uniquely positioned to kind of step into their shoes and basically be the collection agent and remit it directly to the tax jurisdiction. So we're doing that in over 350 jurisdictions in the US and over 23,000 in Europe. So I'll pause there.
We'll talk a lot more about this, but let me just pursue two things. You said that very few of your hosts reach the 200 transaction, 20,000. What percentage would you say it is?
I'd say under 5% currently.
Under 5%.
Yeah.
The other thing I wanted to ask about is there's kind of intermediate steps between doing nothing and paying withholding. Do you provide just general information to your hosts about what their tax obligations may be?
Great question, yes. So every year, we use, I believe, yes, it's Ernst & Young to publish kind of robust tax guidance for our hosts in the US on their income tax obligations, what deductions and expenses they can report on. We also partner with H&R Block. And basically, hosts get email notifications, and we have a robust mobilization team that basically, incentivizes them through a discount to seek tax advice. We also have, designated pages. It's called Responsible Hosting Page that outlines their tax obligations as it relates to income taxes and other type taxes. What we've also found is, when a tax administration has a pretty simplified web page, we link to that web page, and we find that compliance rates are higher when there is that that parallel information that's streamlined.
Do you do chats on, on taxes?
No, don't do chats, but we have a designated customer service line that specializes in tax and legal help.
Great, thanks. Okay, Nina, so let's talk a little about the IRS and what it is doing and maybe a little bit about what it could be doing. We'll explore that a little more as the discussion goes on.
So I have to start my comments by saying I don't speak for the IRS. I don't speak for Treasury. I speak only for myself, who also happens to be the National Taxpayer Advocate, so I speak for her. We've looked at this issue for quite some time, but I have to mention that back in 2002 or so, I recommended that the Congress authorize the IRS to enter into voluntary withholding agreements for self-employed persons. And this came about because we were approached by trade associations such as the hair salons and also by the travel agencies who had independent contractors. The hair salons had people renting booths, but they were having a high turnover because of people, they felt, because people were getting into tax trouble and they'd move on from one place to another. They already had an employee like their receptionist on payroll, and they felt just being able to do some withholding on the independent contractors would really be a good for their business, bring stability. And that sort of temporarily went somewhere in an abortive provision, but we had done the data finding that just to cover Social Security, the self-employment tax on all Schedule Cs that we pulled for the year, I think it might have been 2000 or something, 1999 or 2000, if you had cost of goods and you withheld 3% against their gross receipts, you would cover their self-employment tax. And if there were no cost of goods, if you withheld 5% of the gross receipts, you would cover their self-employment tax. And I continue to harp on that issue because I think that helps us regardless of what platform. The issue with compliance, again, I want to say I sort of view this from a very practical matter, which is that although the digital economy or the platforms are 21st century, this is a problem that has bedeviled tax administrators around the world since there were taxes, is dealing with the self-employed and some variety of the cash economy, whether it's a digital cash economy or other. And so the problem solving is really sort of the same, and it's a stepped problem solving. One is, education, and so listening to you talk about, what you're making available. I have recommended that the IRS actually, participate in Reddit chats and conversations on these things to answer questions that people would have. We are actually working in the Taxpayer Advocate Service on a wizard for people because I think some of what the data has shown is the life cycle of work. And so when you're focusing on the young workers versus the more experienced, or I would say people of a certain age, says someone who just applied for Medicare this week,
wow.
That you move through different stages of your business, and if you can see yourself, if you can, you may not be making much right now, but you may get the self-employment bug and decide that that's where you want to continue to move. And a wizard and education based on life cycle really would make sense there and address the particular concerns that people have. I think that, information reporting is obviously key, but I support, we definitely think not only that the 20,000 should be lowered to 1,000, but what I liked about the Thune bill was it also raised the $600 to $1,000 as a threshold because that hadn't been changed, for cost of inflation, for the effects of inflation and things like that. But I would point out this, that just getting the information is not going to be helpful completely because for rental income, if you have rented out your home less than 15 days, there are no tax consequences. You don't report the income and you don't report the deductions. So
we get a number. If we don't know the 14 days, we're going to do false positives right there. So it's much more subtle than just simply getting the dollar amount. And I think we need to think about that as we do, as we go forward in information reporting. The last thing I would say, or maybe not the last thing, but I was reading last night for a completely different reason, the Coinbase summons appellate case, where the IRS issued a John Doe summons to Coinbase, which is a Bitcoin processor or digital currency processor, to get every single participant that's in Coinbase all the information possible. And the district court and the appellate court, over a period of rulings, narrowed that, but allowed that summons to go forward. And if I were some of the platforms, I'd be very nervous because the IRS's summons authority to get data is very powerful, and they could do a summons just saying anybody that makes over $600 and under $20,000, this is a John Doe summons, give us everything you know about them. And so I think that thinking that IRS can't get that information is sort of lulling yourself into a false security. Now, they haven't paid attention to that, but they have the legal enforcement authority right now, today, to do that. Sorry, I didn't want to.
You're absolutely right.
Yep. So I guess, again, I just close with, this is a new variation on an old theme. And one of the things I've been thinking about is, as we go through this discussion, we look at the categories of workers, we've always thought of this as a binary choice, wage earner and independent contractor. And I do think that maybe what we're seeing in this economy is, in the 21st century, is that maybe there's a third category of worker. And so, what you're putting on the platforms, or, whether they're, whatever kind of platform they are, you're looking maybe at, well, okay, you don't have the obligation to cover these people for your retirement benefits or health care, but you have to provide vehicles for them to get that. And you have to also provide the vehicle for withholding so they don't get into trouble. So there's opt-out retirement savings. There's with voluntary withholding, or maybe opt-out withholding on this third category of worker. And I'll just throw that out as a thought.
Okay. So Nina, you have, Pooja mentioned other countries and some of the issues there. I know you've looked at what other countries are doing, and you suggested to me that some of them may be a little ahead of the United States in terms of dealing with this. Give us some examples.
Yeah, so there are two one thing is, some researchers at the University of Exeter did a really interesting study a while ago where they looked at some of the online the Reddit streams and the online chats and they were focusing on, actually, interestingly, graphic design. There were a whole bunch of graphic designers that were independent contractors but were getting jobs from various platforms. And people would be posting like, well, I just got paid. What do I do? What do I do with taxes? And the community would weigh in. And they really did an interesting study to watch, what the community was saying, and did they ultimately get to the right answer for this person, this taxpayer, and they didn't. There was a whole range of, they'll never find you, so you don't have to report anything, to, you have to do everything absolutely right, and here's what you have to do. And of course, they don't know what this person who posed the question did. But that's led me, that led UK to start thinking about, we need to participate in these chat rooms, or at least sponsor chat rooms ourselves. You can come in anonymously and ask us questions and find out. In Chile, what they have done, and this goes back to my life cycle thing, they have created amazing online accounts. And I will just say that the online account that I saw was shown to me, the Chilean tax agent, he was a senior official in this Chilean tax agency, and he opened up his wife's online account, which was a dog breeding business. And I thought, have you told your wife you're showing us her financials? Okay, never mind. But anyway, the online account, it was geared to what business you were doing, and then whenever guidance, not only could you could do your filing, you could see your past history, you could see all sorts of stuff, but whenever the agency issued something that they thought might be some guidance that might be remotely helpful to you or relevant to your work, they would send you a little notice saying, we've just posted this, here's the link, you can look at this. And so the online account, to David's point about going in regularly rather than episodic, you know, it was someplace that you checked because it had information that you could use that was relevant to you or was salient. You know, that I thought was really the way to have a positive influence rather than relying on traditional tools like audits and things like that, which are so far after the fact and in a gotcha environment.
Can I follow up on that? Yeah, just a second. I just want to ask one thing. Did they translate the guidance into language that ordinary taxpayers would understand?
Well, sometimes, sometimes, and I will say that like the initial email, it might say, this is why this is as important, you know, and here's a summary of it, yes, and then you had the link to the actual, you know, legal, lawyered, official guidance. And that is an art, but it can be done. I mean, I will just point out that, you know, for Airbnb posts, there's a 24-page IRS publication, and for Uber and Lyft drivers, the publication is 50 pages on, you know, and that's just impossible. And that's something we've said to the IRS, you know, make a publication or a one-page or that just is very high level for people to just get them thinking.
Yeah, Dave?
Yeah, just a couple of comments. I think as a general matter, institutional publications, whether they be from Airbnb or
be careful,
from the IRS,
I do publications.
Yeah, and you write amazing stuff. I'm not kidding. I just don't think the average reader will read your average publication, Nina. As a general matter to think about, the question is whether it's push or pull, and whether the tax agency is likely to be most effective at convincing workers in the gig economy or homeowners in the gig economy or others in the gig economy to pay attention to complex tax provisions. And whether there might be, and again, obviously it's from a business perspective, but when I think about, we have ongoing engagement with folks with regard to their accounting practices and an opportunity to partner with the IRS and frankly with state departments of revenue, depending on their tax practices, to prompt people at the moment when they are in the midst of their business transactions or whatever in ways that they may understand. And I actually believe there's a huge opportunity here to avoid the 25-pager, even though, and Nina, I kid you not, anything that you write will be great. I just don't know that people will consume it. And so it's figuring out at that moment how we really get their heads around it.
And I think Pooja's point about where there is a simplified tax agency page, linking to that is it's very important. I don't think the IRS should step out of this dialogue. It needs to translate how it is interacting in this dialogue and provide things that then can be used by third parties to share. Because I agree, you know, but I also have to say, you're talking about other countries. There are other countries in the world, shocking as it might sound, that their tax agency is actually the most highly respected government agency that they have. And it's viewed as something to help people. And it's viewed as supporting small business rather than placing burden on it. Now, you know, that's different from the United States, but you know, hope springs eternal that we might be able to be helpful and be viewed as a reliable and, by the way, accurate source of information that's readable.
I have one point really quick. I think that there are some platforms that are doing innovative work exactly in this space, and Lyft is one of those platforms. They have taken the initiative to go ahead and give all of their drivers, regardless of the fact that, you know, they're not legally required to give a 1099K until their drivers hit the 20,200 threshold. They give their drivers a 1099K at the $600 threshold. They also are really good about pushing out notices to remind drivers to file quarterly estimated payments. They really go and do what they can to help prompt and actively try to be a source, not unlike Airbnb with the EY report. I cited it in my work because it really is a good report. And you know, rental income is tricky. It's different than typical Schedule C income, and there's self-employment taxes that aren't necessarily, those issues aren't necessarily involved with rental income. And you know, the platforms are doing some of that work. But I think it also begs the question of, if there's one or two platforms that are doing a lot of this work, why can't we create an industry standard? And if we can see that Lyft can give everyone a 1099 at the $600 threshold, regardless of whether or not it's on or off platform work. And now some states like Massachusetts and Vermont are already requiring the platforms to issue 1099Ks at the $600 threshold. It just needs to become more of an industry norm, and the federal rules should be updated for that.
Pooja, what would it take? What do you need from the government in order for you to lower the threshold and file 1099s for more people?
Well, we would need a law in place. I think what we really look for is equity across the industry. We are reporting in Vermont and in Massachusetts. I think, we're the first in a lot on the indirect side, but it does come at a cost to the company. Like I said, we're a technology company first. To kind of give you an idea of our internal tax house, we have a mighty team of about 20 people, and 2 people that are sitting in this room on the tax policy team. And we have 3,000 employees globally, right? So there's only so much we can do proactively, I think.
Well, be more specific. You say more equity, you mentioned the Thune bill, but more specifically, what would be in the legislation
Okay.
For you to say, okay, this is now doable?
That's a good question. I mean, we haven't really done a robust study of the numbers, and our business model and the hosts that are coming onto the platform are more professional. That's what we're seeing, and we're seeing more of the casual hosts who rent a couple of times a year drop off. On average, we have in the U.S. An average host rents 42 times a year and makes just over $7,000 a year. So I think we would definitely lower the threshold to kind of see where our average host in the U.S. kind of falls. I think honestly, what I had said before, withholding is tricky for us. If we can remit payments instead of withhold. Report payments instead of withhold, I think that would be something that we would definitely support.
But with all due respect, I think you're missing half the equation here. I think one part of the equation is what can the platforms do to enable folks to comply with what they know. But our data suggests using our products that our folks in the self-employed area are discovering thousands of dollars worth of deductions they didn't know about. Mm-hmm. And so while it's great to provide the non-employer information that you're providing, I think it's also important how you enable folks to identify expenses and deductions that they may actually take. And I think there's a huge gap there depending on the sophistication of the people that we're talking about and the amount of education they've had.
So how do you close that gap?
Well, I think Nina's got part of it. The way I'd put it is it's an and, not an or. Certainly tax administrators and agencies need to provide communications that are understandable. I see nothing wrong with linking to one-pagers and so on, but I think you need to go where people live and work. And where they're, when is the mind, what is that point where you can capture their understanding? It's generally around the time the transaction's occurring. Mm-hmm. When you're sitting in your car filling the tank with gas, may be a better time to capture that expense than at the end of the year when you sit down to do your taxes and realize, whoa, I didn't capture all of that, and find out at that point. So I think I would, obviously I'm going to argue for partnering with industry so that you have both, not an or and and. You have education that comes from tax administrators, that comes from the platforms to the extent people sit on a platform, and you look at the products and ways people actually do their work. and see if there are ways you can leverage those products and services to enable people to comply as well.
And that's what people are doing. I talked to a gig worker just this morning who said, yeah, I have QuickBooks, and I do real-time expensing through that product, right? Like the private sector can, help with the prompting of that expensing because, as you know from my 2016 research, people are getting shortchanged because they are absolutely not aware of how they can properly claim and report their expenses, and that's even more important today with 199 Cap A. If they are going to get the full benefit of that deduction, they really have to properly report and can't just throw up their hands and decide they're not going to file altogether, which is oftentimes what happens when people fall behind on their quarterly estimated payments, and then they go in April to pay, and then they realize they haven't reported for the entire year or even the prior year, and then they just give up and walk away.
So, how I see it and how I see the role of the tax agency is like somebody starts driving or starts selling something on Etsy or eBay or wherever, and they need to get a federal ID number, an employer identification. That's where they come into the federal government. And so they should be entering into a page that is dedicated just for them, that is a wizard that walks them through, and they get to say, well, this is what I'm doing. I'm driving, or I'm Airbnb or whatever. And that takes you down a tree that friendly and not deep into the details, but you should know the following things. Once you've got your EIN, now you're into Airbnb. Well, here are some very simple rules about the 14 days under, equal or over. Here, maybe linking to that 24-page publication, but if you have a one-pager, that's great too. But then the other things that you need to think about, like your estimated taxes, you can sign up for emails or text reminders about your estimated taxes. Do that here, et cetera. Would you like to create an online account? Do you want to create a way of making those deposits, having those deposits come out quarterly or even monthly from your account so that you don't have to worry about it? That is what a tax agency can and should do. That is, and then all the other products that are out there, the software products that feed into, your tax return and things like that, that's great. But those core things we should do, and platforms should link to that. As a starting place, you need to get your EIN, go there, and that gets you off on the right foot. And then you can even say, create this online account if you want more updates on your particular area, that you are a craft seller, or whatever. And it doesn't have to be super detailed, but detailed enough, into buckets that people can see themselves. Sure. And that is, we are not there. We are not even remotely close to that. Well, although there are other countries that are doing that.
And just one thing, sorry, that's a really good point, Nina. We can collect all the information hypothetically that a tax agency wants. What's tricky is verifying that information, right? So to actually have information on our website where the host knows exactly where to get their EIN if they have it, or their social security number is huge, because a lot of times we find that when they don't know it, they just make it up, and we have no way of verifying it. So.
Right. And the other thing for that site is then you can say, people, we're having a webinar, like sign in, we're having and have IRS experts so people could ask them questions. And that is as helpful to the IRS to hear from people directly about what they're facing. That leads to better guidance and information, in the long term, and helps everybody.
I wanted to ask Carolyn about the self-employment tax, and you talked a lot about what you found. Can you talk a little about why people don't pay the self-employment tax? Is it because they don't know, or because they're cheating?
Yes.
That's a good question. I think on average, people underreport their income. And I think that's what Treasury TICTA data shows when you look specifically at their audit reports on self-employment tax. People, if you do the averages on what little work has been done by TICTA on this, people underreport their self-employment income by $1,500, give or take. And I think that it's not helpful when you have an entire population of people that's not getting any 1099 and they know that the IRS isn't either. And that's the world that we're operating in now. And what you're seeing with the digitizing of the cash economy is you're seeing people recognize that they don't have to file a 1099 MISC if they go ahead and do electronic payment, and they can somehow fall under the 1099K rules. People are now exercising. There's some great law professors who have coined this term tax opportunism with respect to the on-demand platform economy, and I think that that's what you're seeing happening. And, you know, again, to Nina's point, this is not new. I work with a guy named Jim White, and he was head of tax research for GAO for a gazillion years, and he and I have been looking at these issues together for a long time. And when I sent him my latest paper, he immediately wrote me back and said, "Your numbers are too low. They're way too conservative," because he literally wrote the report for GAO that 61% of sole proprietors underreport their income back in response to the tax gap report that was issued in 2007. And I said, "Jim, I want to be really conservative, and this is what we can, you know, substantiate with the data out there. But, you know, we used an average underreporting rate of 44%, which he would even tell you that that's too low." I mean, this is just how people operate today, but it doesn't have to be that way. At the very least, we could at least give these people a 1099 and let them know that the IRS is getting this information too, and prompt them to report.
Several years ago, again, part of this 2002 thing, because we did a piece on how to address the cash economy, one of the things we suggested was on the sole proprietorship schedule, on the Schedule C, rather than just asking gross receipts, you break it down to two lines. What are your gross receipts per your 1099s? And what are your other gross receipts? And, you know, that's a small nudge, but whether it's then the software companies pick that up as two questions. You know, enter your 1099s, and now what's your other gross receipts? So you're converting somebody's act of omission into an act of commission. To answer that question and your other gross receipts, you're going to have to lie, as opposed to just, well, gross receipts. You know, here's what I got 1099'd on. You're making it more visible. And that is where again, the agency, really thinking about human behavior and how to, to use that word, nudge human beings into being more compliant in a very enforcement way. And then, the private sector and others picking up on that. That is not a trivial thing.
Pooja, I want to come back to you. And I'll ask what may be a sensitive question, but I'll try it anyway. So, how much of your unwillingness to provide the 1099s is kind of an administrative issue, a cost issue, and how much of it is because you don't want to be considered an employer?
That's a good question. I don't know. I can't really speak to that. I think, honestly, looking at the facts, I think Adam brought this up. There's a recent California Supreme Court case decision that spoke to this. We don't really have any relationship with our hosts. It's very different from the ride-sharing platforms that you see. So I would say that it's the former. It's the administrative aspects, and it's honestly not even the cost. It's really just we want a level playing field. So to Carolyn's point, if there is an industry standard, we're totally on board. But it's the unwillingness. I wouldn't use the term unwillingness. It's just that we see this day in and day out. The legislation hasn't caught up, right? So once it does, we're on board. But
so the 1099K argument, administrative burden, doesn't really hold water in this context when it comes to platforms. It very well might be a real issue for smaller businesses, but when you have some platforms that do give 1099s and you have some platforms that don't at the $600 threshold, and you have some platforms that are actually doing collection of hotel, state and local occupancy taxes, I don't think it's an administrative burden issue that's going to cause Congress too much heartburn, right? Where I think it gets more complicated is when you try to more broadly require 1099 reporting to capture the digitizing of the cash economy. I testified a couple weeks ago before the Senate Small Business Committee, and one senator who was asking questions about this very strongly pointed out that she had been on the receiving end of small business ire after increased information reporting was included as part of the Affordable Care Act, and how they had to repeal it, and how it was just a failure across the board. And that was the first hint that I had that members are very reluctant to wage back into the 1099 information reporting waters.
Could somebody, we talked about the Thune Bill, somebody want to describe what the Thune Bill actually does, what the GIG Act does? Would you want to
Sure, yeah, I have
summarize it?
the, yeah. So basically, it would lower the reporting threshold, the $200, the 200 transactions per year, and the $20,000 transaction, $20,000 per year. With, I think, eliminating both transactions. I think also it increases the $600 standard deduction to $1,000.
The miscellaneous filing. And then it also includes that safe harbor for certain platforms that are overtly concerned with misclassification issues. And it's not just the alignment of the 1099K with the 1099 miscellaneous. It goes even further, and I think it allows some platforms to include, I believe, some voluntary withholding agreements if they choose to, but it also creates this safe harbor. And that safe harbor provision is effectively a poison pill politically, in contrast to the Shabbat bill, which was introduced on the House side, which just focuses primarily on the alignment of the 1099K and the 1099 miscellaneous thresholds.
Explain why the safe harbor is a poison pill.
Because outstanding questions on misclassifications. I mean, misclassification questions have long divided political parties, and trying to resolve those questions with a legislative solution is rarely successful. I mean, that's why the Revenue Act of 1978 has not been touched, right? Like, this is, misclassification issues tend to really divide Dems and Rs, and the Shabbat bill on the House side is one that I worked on and testified on with the majority staff in putting that together. And I strongly advise them to stay away from the safe harbor issues, just focus on the alignment, because this should just be a compliance issue. And because they did that, it's a bipartisan bill. The leadership of the House Small Business Committee introduced that bill. Although the Thune bill, I believe, has some Dems, it's going to be really hard to push that through the Senate overall.
So let's get to the bottom line here. So if something like the Shabbat bill passed, do you think that would sufficiently address the concerns of the platforms that we could make some progress here? I think
that there's not a particularly harsh administrative burden from requiring platforms. I'm not saying all businesses, but platforms specifically, for giving 1099Ks at a $1,000 threshold. At the same time, the 1099 miscellaneous level $600 threshold has been in the tax code since it was instituted in 1954. If you adjust that for inflation, as Nina suggested, that would be over $5,000. And I think having alignment so you limit tax opportunism is where we really need to be to start to make progress on this issue for tax compliance purposes. Now, it doesn't get to really the looming issues of how the gig economy is going to change or the digitizing of the cash economy, but is certainly a step in the right direction. And we know, based on the score that JCT did of the Thune bill during the November tax reform debate, that it raises at least $3.6 billion. My numbers are almost double that. So I think that there's more work that needs to be done by JCT in considering the entire landscape of this population to up those numbers. So it is a big revenue raiser.
Just coming back to, I think that the importance of voluntary withholding agreements can't be overemphasized.
Right.
it puts it back into the marketplace, like you're willing to offer this to your employees, so that may make you more desirable because you're helping them stay out of trouble. Others may want the cash and run. But the point is that having that authorized in the bill makes it possible and gets us closer to that third category of worker and sidesteps the worker classification binary choice. Now, there are all sorts of public policy reasons for not doing that, retirement, income security, et cetera. But I'm a tax administrator, and I need to get the revenue in. I mean, I personally don't, but the IRS as a tax administrator does. Yeah. On the other hand, I want them to do it right, and I want them to do it well. And that goes back to why we recommended the 3% and the 5%, because our data showed how many people were sole proprietors who were marginal. So many of the sole proprietors, and your data from the first panel is showing this over and over again, that many of them are not even required to file tax returns but for the self-employment tax. So you don't want some large percentage, and focusing on the self-employment tax addresses some of your concerns that people aren't paying that into the system. With a 3% or 5% percentage, depending on cost of goods, you would be able to get that into the system.
Okay. Just a quick comment on the whole voluntary withholding agreements. From an industry perspective, what we've seen in other countries for businesses actually partake in it is some kind of incentive for either the corporation or their hosts in terms of tax-free thresholds, greater withholding thresholds, and so forth. Denmark is one of the first movers and shakers in this arena.
Well, and you see that on the VAT side, when countries have value added, there's a threshold, like gross receipts, like UK, I think it's £15,000. We don't care about you. Now there's bunching around that. But the point is, it's a recognition you're too small to have to deal with this, and that goes to some of the burden that people are feeling.
Mm-hmm. Nita, do you think that the move to the platform economy, whatever it is, as well as 199A, are going to discourage more people from the cash economy? Are we going to get people making the shift at least to the, or the incentive still not enough?
I don't think so. I think there will be always the true cash economy. I mean, I travel the country. I go to so many places that most people have never been in this United States talking to taxpayers. And, they're not on digital platforms. Some may be in the community, but others are just doing transactions as they've always done transactions. And so I think what, the platforms have done in the digitizing of commerce in a way has added another wrinkle, but sort of in the same way that coins did back in the, first century BC? I mean, it just had the same effect, and we're just seeing it. And I don't mean, I'm not being a Luddite, I'm just saying that human beings are, life in all its fullness is how they undertake their commerce.
Okay, I agree with that.
But
however, there's been really great research done on the ubiquity of smartphones. This is how lower income communities primarily access the internet.
So there's an opportunity, but I don't think it's going to get away from the cash economy operating.
That's true, but I mean, I will say that when you look at some of the great work that Pew Research has done on smartphones, and I think their report that they did in 2015 or 2016 said that 88% of Americans use smartphones, and that for something like 60% or more of lower income households, that's their primary access to the internet. Smartphones are what is going to be driving this in a way that's different.
Right, but you also have to look at how they use it. And our research has shown that the low income and the elderly, for example, do email once a week. They use their smartphones for texting and things like that, but they're not using it for more sophisticated stuff. They're actually, a lot of them are using it for Skype and face-to-face and things. And those are all opportunities, and they're even opportunities for the tax administration. Imagine, calling up the tax administration with a question and being able to see the person who's assisting you, and more importantly, the person who's assisting you be able to see you and be able to see that you're confused, you don't understand what they're saying to you, and that prompts a better conversation. Those are real opportunities.
Dave, what do you think about this cash economy thing? Are we going to see some sort of qualitative shift away, or is this just always going to be with it?
So I'm actually intrigued by Carolyn's argument that folks are beginning to use digital currency, use Venmo, Zelle, whatever it might be, to make payments. I don't actually believe the cash economy is going away anytime soon, because I think, this is me speaking, not my company, but I think that people, where there's a will, there's a way to find opportunities. And we see that, the author of the last tax gap study may be in the room. I don't know if it's the last one, but close to it. And it has always been thus. The lack of verifiable data with the tax administration agency leaves people with opportunity. What we've just talked about are ways of closing that opportunity on one side, which is require the platforms to report something. But we still haven't got on the other side, which I'm still interested in, which is what is the expense deduction? What are the other opportunities people have? I would suggest that we continue to struggle with this. I believe that Nina's point about nudges and prompting provide opportunity, but there isn't a silver bullet. It is a set of things that goes through, and at the end of the day, we will still have a long tail of residual opportunities that will occupy rooms like this for years to come. Yep. So with people like this.
I think that's right. But I think that there's not a silver bullet, but one of the things that Nina has talked about, and it's something that I picked up when we were together and I testified in July, is look, if you could do such simple things as changing the deadline for quarterly estimated payments for the second and third quarters so that those deadlines fall after the quarters, that might really help increase tax compliance, right? Lowering the 1099K threshold, or as Nina has suggested, if you created some sort of informational toolkit that platforms could provide their workers as part of the onboarding process, right? Like those are.
But I actually have to say, I think that's great, but that is not going to solve tax compliance by giving workers a handout when they join the platform. I think that's actually a great thing to do, but I think it's naive to believe that that is ever going to result in much tax compliance.
Yeah, see, where I think it is that they have to come in to get an EIN. So, I mean, they don't all have to, but some of them do. So when they come in and have an EIN, that's when we get them down that road.
Absolutely.
That is just, here are the issues. Do you want emails, things like that. If they don't come in, well then,
I'm not saying we shouldn't do that.
No, I know. I agree with you that it's just, as with all compliance work in any area, there's the whole continuum of activity that you need to do and different kinds of touches. And thinking that, information reporting is going to be the end-all, be-all. It's important, but then what does the agency do with that information and how does it use it? And to Pooja's point, the court decisions say that if the IRS just went in and said, you owe this tax because of this 1099, the IRS bears the burden of the proof because that information may be wrong. It's not based on the taxpayer's books and records, it's some third party sending this thing out. Yeah. And so we have to be very careful thinking that that's going to be the answer to everything. It's part of the solution.
Sure. Just two comments. One is, I think you probably got folks' attention when you said that the IRS could, with a John Doe summons,
I just thought I'd
obtain all of the data. And I think that's true. There are many things the IRS could do with resources, capabilities, and time, none of which are in excess supply with the IRS at the moment. So I think the reality is, what is the most effective way to enable compliance for those who wish to, reserving the IRS's more draconian tools for those who don't? So that's part. The other thing I'd say is, having moved to the private sector after 30 years in government in various aspects, I've had the privilege of watching how at least my company does cognitive research, and it's evolved over years, and it's become incredibly sophisticated. And I was privileged to watch a customer proceed through completing his tax return at home with his wife, who was out in the background and then shouting at him from the kitchen. And, but he talked through the way he was thinking about the things. And there is nothing more powerful than realizing that people don't see these things the way you see them. And the you in that sentence is people like us, maybe not all of you, but who come with biases, education, years of understanding. That is not the customer experience necessarily. And it is only when you step back and watch where their eyes go and how they talk and what the wife says to the husband and then takes over part of it because he doesn't get it, that you realize things that we think are simple are really complicated for folks because they don't engage in them and they don't know what these words mean, let alone what to do with them. And so that, I think, is a next part of engaging, and it's something I think tax administration will hopefully get to. I'd love to bring it back, but I think that's why this is not a single solution. It's a variety of things to recognize where these folks in the gig economy really are.
I think that, to follow up on your point, though, I had a conversation with Dave Cowder. He's been really good about coming back to AU, and we had a conversation in May about the future of tax work, and I specifically asked him about this 1099 question and what his expectations were for the IRS or Treasury. And he really emphasized to me that he had really hoped that there would be private sector solutions. And you know, I think that that was something that I was not anticipating, but that, you know, I think that it was something that should be noted, that's a little bit of insight as to what they're thinking.
Well, that's where, with all due respect, that's one branch. I think that there are others thinking otherwise. And when you have the self-employment, the unincorporated business component of the tax gap having, I think the last time I saw it, it was a 43% correct, is it a correct reporting percentage? Something like that. That's a stunning number, and the IRS's failure to play in that sandbox repeatedly is unexcusable. And so to say that the private sector is going to do something about that and solve that is ridiculous. It is the tax agency, it is the tax administrator, and it has a role to play. And that role doesn't have to be all audits. You know, my deepest dream is that people would respect the IRS and look to it as a source of information that's understandable. And that would be the launching off point to, you know, consulting with your tax experts, your preparer, whatever. But to just walk away from the self-employed sector and the version of the digital, you know, the newest flavor, which is the gig economy or whatever we want to call it, is just not acceptable for a tax agency in the 21st century.
I just want to throw one. Go ahead.
Just one thing. I actually agree with Nina, amazingly, on this point, which is that, you know, look, the notion that the private sector is somehow going to be the compliance and enforcement mechanism for the IRS is a bit naive. Right. I think there are places where that can occur because, you know, it's sort of the Venn diagram of the intersection of interest, because our interest is enabling our customers to meet their obligations. And so we can, in that space, be a partner in helping. But we are not an enforcement arm, and our customers wouldn't be our customers if they thought the first thing we were going to do is to tell the IRS what they're doing wrong. Right. So it's a component, again, of an overall approach to thinking about this, and the agency has clearly a role to play. So does industry, but there is an intersection in the middle where we really can partner together because it is in the interest of the taxpayers and the tax administration system.
I just want to throw out one other thought.
And world peace. Did I mention
world
that?
peace.
World peace.
I just want to go back to what Carolyn said at the very beginning of this conversation about home care workers. And there's also kind of I think, an important issue on the customer side, the demand side of this. If I can hire a home care worker for $10 an hour off the books instead of having to pay $20 an hour, if I hire somebody through an agency, which am I going to do? So I think there's a whole set of other issues that we have to think about as we think about compliance.
Right, but what if that home care worker is like my babysitters and asks to be paid by PayPal? Right? Like, I pay all of my babysitters. I got a 4-year-old and a 5-year-old. My husband and I both work full-time. You know, our home economic questions definitely revolve around care. right, for our children. And you know, in the last 2 years, our steady supply of babysitters has all been asked that we pay via Venmo or PayPal. None of them want cash.
Well, but there are plenty who do because they don't want to pay cash.
But Carolyn, if that happened and they suddenly discovered that if I use Venmo or PayPal, the IRS is going to get it and find out about it,
they might
don't you
switch
think
back.
that might change their behavior?
They might switch back, but when you talk to them, just how they use, at least the ones that I've talked to, right? The college students that I interact with every day and that I talk to on campus, this generation, they use Venmo and they think it's cash.
Yeah, I
Right.
use Venmo to pay my rent. I used to. I'm not that
Right?
young.
I mean, it is a different way, and it really is going to challenge our understanding and how we get data, because the J.P. Morgan Chase Institute data is the best data out there about the on-demand economy, and it's all connected to a bank account. But your PayPal or your Venmo doesn't necessarily have to be connected to a bank account. It can be connected to a credit card or a debit card. That's not necessarily connected to your
Well,
bank
the
account.
IRS has the authority to summons credit card accounts, and it has. I'll just remind, I mean, and to David's point, are we going to, is it going to do that? No, but it could decide to do an initiative, as it's done with the offshore credit cards back in 2001 and 2002, which was very effective. And so, it's possible. And, the point is, why, to me, for the tax agency, I'll come back to that word, there's a continuum of its activity. And so if we put the tax agency in a position where all it's going to do is the enforcement side of it, you have a tax agency that's going to breed even more non-compliance than we've got now in that sector. So you have to have the tax agency thinking about, as part of this overarching strategy, which includes treating the private sector as our true partners in this, in the appropriate places, how do you touch that taxpayer at different points in time to get the maximum compliance and change non-compliant behavior to compliant behavior when you identify it. And that's how you have to frame everything that you do in tax administration. Or all you're going to do is just go to the quick and dirty, we're going to do X, we're going to do this audit, we're going to do this, and you're not going to have the change in compliance behavior that you need to get. Your numbers will always look the same.
We have about 15 minutes. I'd like to get some questions from the audience. Carl in the back.
Thanks, Howard. My name is John Doe. I'm a taxpayer, and I'm a small-time contractor, and my income is not the majority of my household income. I've been trying to, and maybe because of my own clumsiness, but I think there's a lack of coordination between Social Security, which I'm glad you brought up, that if you don't pay, report your taxes, you don't get credit for Social Security. So I noticed on the Social Security record of my earnings, there was a missed small check, a 1099 from a few years ago, and last year's earnings were a weird number when it should have been a round number. It missed several $1,000s. So I called up Social Security, and they said, you need to send us the 1099s, and I did, and then I got a letter from the local office. They said I sent the wrong information. You need to send your tax returns. So I interpreted that as, John Doe, go away. So to get the tax returns, I need to get my wife to give me the tax returns. But anyhow, I don't know how do they coordinate on this? In my particular case, I'd rather pay the taxes than to get the credit for the Social Security.
Right. So I would say two things about this. One is, if you want to come up to, well, where's Chris? Chris, I saw you. If you want to give your information to him, we'll get a case advocate to help you reach out to Social Security and try to get those records fixed. So that's the first thing. That's what the Taxpayer Advocate Service does. One of the things. But the W-2 information goes from employers directly to Social Security. And then Social Security sort of perfects it, makes sure that names and numbers match and stuff, and sends it over to the IRS for us to put into our records. That's different from the 1099s. The 1099s come from the payors directly to the Internal Revenue Service, and then what Social Security gets from us are your net self-employment earnings from the income tax return. So the 1099s themselves wouldn't show up in your Social Security earnings. It would be your W-2 plus whatever your Schedule C net profit is that you're reporting on your Schedule SE. So, but we can look at to make sure that that's on your record, and if not, we could figure out a way to get that information over to Social Security. But the Social Security and the IRS have an exchange agreement for that SE income.
Okay, other questions? Yes, ma'am. Hold on just a second for Mike.
Hi, a point and then a question. This is very helpful. I'm Mindy Reiser. I've done a lot of work internationally as well as here. Given harangues on civil servants by certain political figures, this must impact the way people see government agencies. I just leave that there. On the more positive side, Nina, if you could say a little bit more about those countries for whom the tax authorities are, if not beloved, at least esteemed. I was quite intrigued with that. Are these largely Nordic countries or not?
Yeah, most of them are Nordic countries. And so you do have to look at that, they have some of the highest tax rates, if not the highest tax rates on individuals in the world. But they have a culture of getting services and goods from the government. Higher education is free. You have 6 months paternity leave, 6 months maternity leave. The health care in those countries. So there's a sense of what you get for your tax dollars that I think there's a disconnect here in this country. We don't understand what our tax dollars go to. We don't really have a very good understanding of our tax rates or our tax system, as David was noting. We just don't have that understanding. We certainly don't have a connection between what taxation does and gives you. In UK, there was a point, and I don't know whether it's still up on their website, but on their online account for individual taxpayers, you could go on and see what you paid in income taxes over the last year, and where it went. And it was really sort of cute because it had you paid for 1/8 of a teacher's salary, and so there was a little teacher with 1/8 of it, colored in or something. There was a little gun, and that was for defense or something like that. But it was you could actually see your own little pie chart of not just the larger pie chart, but how yours did. I have proposed for many years and threatened to do this myself and may do it this year, doing a survey with people where they could color in their own pie chart of where they wanted their tax dollars to go, on the assumption that maybe if you added up all that pie chart, it might end up where we actually are as a country. Some people would put everything into the arts, other people would put it all into foreign aid, other people would spread it out to military, defense, whatever. But maybe you would find that blended, you end up where we are. Maybe you wouldn't, but that would be a very interesting thing. And I've thought that if people got a tax receipt that told them this is where your money is going this year, and you get to color in where it is for next year, and we'll just report it, it's not going to have any binding effect, but it might get more participation and awareness of the system.
I wonder if I could just follow up on that. I chaired the OECD Taxpayer Services Group for 3 years. So that's composed of essentially between 40 and 46, depending on the year, tax administrators from around the world. I saw the Chilean personal account in its naked glory when the Chilean representative put it up on the overhead for all 43 countries to look at. It was his own. They had compiled not only his federal taxes, but his state, his property. It was the full Monty, if you will, with regard to that person's government interactions. I've dealt with the Nordic countries, the Germanic countries, Asian, and what I would tell you is that culturally they are in very different places. I've lived in Scandinavia, and I can tell you there's a different attitude about government and its engagement with its citizens. And so while it is instructive and interesting to learn from those countries about how they're thinking about tax administration, it is often difficult to translate those lessons into our culture and our country. And in today's fragmented society, even more difficult than one might have assumed it used to be.
But, that goes back to, I won't cede ground on that.
Of course
that I do not think that means we should not try to educate United States taxpayers about what our tax system is, et cetera, and to try to get more engagement. It will look very different. And I've thought deeply about this. It will look very different from all the other countries. That's fine. But for us not to even try, that's a problem.
A couple more questions. Yes, sir.
I'm Brian Tumulty from Bondbuyer. My question's for Caroline Bruckner about Massachusetts and Vermont and their lower threshold for 1099s.
Yeah.
So what has been the taxpayer reaction, and what has been the revenue increase for state governments, and are other states considering doing that? And might that influence Congress someday if it goes over well in the states?
It has, I haven't talked to tax authorities in either Vermont or Massachusetts. You might have. But I have talked to some of the firms that do 1099K preparation. And I did that in preparing some testimony that I gave to the Senate Finance Committee in July. And they told me that it has catapulted reporting by over 100%. And informally, I looked at chat boards and Reddits in January and February, and all these Uber drivers and Etsy shop owners were complaining I suddenly got a 1099 because I had never had one before. And so there was certainly the first wave of surprise. But that's what I've understood informally. What I think you should know is that California's State Tax Franchise Board just put out a presentation on the on-demand economy and how it's playing out in California. And they noted in that presentation that of the top 100 platforms, less than 12% gave 1099Ks to their workers. And, states are starting to become very cognizant of this issue, and Vermont and Massachusetts are first movers, but New York and California are not far behind. And once you have the states requiring the alignment of the 1099 miscellaneous and K thresholds, the federal government will be soon to follow, because that information is already getting reported anyway, is my suspicion.
Well, Pooja, actually, it's an interesting question. If you get New York and California doing this, does the federal government have to do anything, or at that point do you just do it for everybody, just because you're doing it for such a large fraction of the population anyhow?
Yeah, I mean, from an administrative standpoint, we don't mind. We would just need the federal government to, again, pass a law that would require us to do so.
I think it's somewhere if you get, like half and half, and then, that becomes a burden that you have to keep track of, okay, this state. So that's where you have pressure or cover for the federal government to do it. Then you're simply making it the norm for every state rather than on the federal level, and then the states can piggyback and get that information.
And it changes the politics, because from the platform's point of view, they don't have to comply with 50 different state rules. They just want
exactly.
one, so.
Right.
One or two more questions. Eric.
You.
Thank you. Great panel. You've been talking about various tax administration issues, and I was wondering if there were any policy recommendations that might make the system easier to administer for independent contract workers and put them on a more level playing field with employees. Dave mentioned you should keep track of when you buy gas, and it occurred to me, well, if you're using the standard mileage deduction, you actually don't need to do that because the company will. So could there be a standard deduction for expenses generally, or something of that sort?
People have thrown that, we have the small business, sort of the home office standard deduction. I thought that was a very important piece to eliminate some of that sort of record keeping and things like that. I think that would be something that you could look at the data and see what percentage cost of goods is for these kind of businesses by industry codes, and maybe come out saying, if you want to play it safe, you could just take this percent. I know that there are countries around the world that in trying to look at, am I going to look at this entity for an audit, whether it's in a VAT or somewhere else, they're using that kind of big data to do it on their compliance side and their case selection side, but nobody's brought that into the policy side, except where you see exclusions for VAT. Like, we're not going to mess with you. We don't want to get the smallest of the small sucked into this program.
Let me get some other answers to that question. Pooja, go ahead.
Sure, just from a platform perspective, right? Given the fact that we're global and we're operating in over 180 countries around the world, simplicity. I think in terms of the voluntary nature, incentives, right? And just also from the individual's perspective, they don't feel bought in. They're not receiving any benefits. So a standard deduction or some kind of tax-free allowance would be wonderful. Also, I think platforms generally do like the voluntary nature of withholding or reporting. And yeah, with 1099 reporting, or just if you think about our business model, right, for a second, we're taxed at every single level. The guest is taxed, our hosts are taxed, the corporation is taxed. We're talking about indirect taxes, sales tax, and in the U.S., our business is very state and local, and you know, we're not investing on the tax professional compliance side as much as we are on the technology side. So to keep things streamlined would be hugely beneficial for also platform compliance.
I've thought about this question because people have asked me, shouldn't there be a small business deduction for gig workers regularly? And my response to that is, we just spent $415 billion on 199 Cap A. Why don't we see how that works first? Right? Like, how are you going to get the political appetite for people to go back to that well when they just fought to get 199A? And I don't know that a standard deduction in lieu of or in addition to 199A, how that would look. Or, and I would suspect that it would be a harder hill to climb.
What is 199A?
199 Cap A is a tax incentive that was included in tax reform, and it's an up to 20% deduction for individuals with business income. As part of tax reform, they reduced the corporate tax rate from 35% down to 21% to create more of a level tax cut for the majority of businesses, which are small businesses and individuals with business income. They included this brand new 20% deduction that people that aren't incorporated, that so long as they're not in services above a certain threshold, can take up to 20% of their income. Now, there's some complications around how you calculate it. There's some complications around how you calculate it once you get above certain income thresholds, and that's about $315,000 for a married couple. And beyond that, if you actually make more than that and you are in services, you're phased out of it altogether. So, but that generally is not going to impact this population because the majority of on-demand workers are not making in excess of the income thresholds for the 199 Cap A deduction.
You know what might be interesting is over the years, right, that over the years you could look at the 199 Cap A data and sort of
and see if it works.
You know, really should we do a standard deduction instead? That would be very interesting, looking at the incidence of it and the distribution and things like that.
But from a budget perspective, it's a lot of money that they just dumped into this, right? Like, how are they going to...
If you've already had the
Well,
budget.
they still need to clarify all of the rules around it, which is one of the things we're struggling with, which is there are huge, notwithstanding the 184 pages of guidance.
Well, it used to be 261, so count your blessings.
We've got some more.
Okay, I think we are out of time. Let me thank our panelists, Dave, Carolyn, Pooja, and Nina, for a really good panel. Great discussion. Thank you.
Yay, to you. That for ourselves really neat.